Did you know the same $390 after-tax cost could leave you as about $62,500 richer after 30 years? If your IRA contribution is deductible. Our example compares $500 monthly into a deductible traditional IRA with $390 into brokerage, both earning a hypothetical 7%. But the deduction is not automatic. Your income, filing status, and workplace retirement coverage can completely change the winner. Today we'll compare the 2026 rules, access taxes, real numbers, and the easiest way to choose. A traditional IRA is a personal retirement account where contributions may be deductible, and investment growth is generally tax-deferred. For 2026, the combined traditional and Roth IRA contribution limit is $7,500, or $8,600 if you are 50 or older. The limit applies across all your IRAs, and contributions can generally be made until the tax return filing deadline. If neither you nor your spouse is covered by a workplace retirement plan, the traditional IRA deduction generally has no income phase-out. If you are covered at work, the 2026 deduction phase-out is $81,000 to $91,000 for single filers. For covered joint filers, it is $129,000 to $149,000. Different limits apply when only your spouse is covered. You may still contribute when the deduction is unavailable, but non-deductible contributions require careful Form 8606 record keeping. Inside an IRA, you can usually choose investments such as stocks, bonds, mutual funds, ETFs, and cash equivalents. A brokerage account also holds investments, but it uses after-tax money and has no special retirement tax wrapper. Brokerage accounts have no comparable IRA contribution ceiling and no retirement age restriction on withdrawing available cash. However, interest, dividends, fund distributions, and realized gains can create annual taxes and reporting forms. Both accounts can hold the same investment. The account changes taxes and access, not the investment's underlying market return. Traditional IRA distributions are generally taxed as ordinary income, except for any properly tracked non-deductible basis. You can withdraw from an IRA anytime, but before age 59.5, taxable amounts may send additional 10% tax. Exceptions exist for certain situations including qualifying education, some first home costs, disability, and specific emergencies. Traditional IRA owners generally must begin required minimum distributions at age 73, even if they are still working. Brokerage that withdrawals have no retirement penalty. Selling may create a gain or loss, but moving cash out itself is not the taxable event. Hold an investment 1 year or less, and gains are generally short-term. More than 1 year is generally long-term. So the central trade-off is clear. Traditional IRA offers possible deductions and tax deferral. Brokerage offers flexibility and unlimited capacity. Meet Alex, age 30. He wants to invest for 30 years and can afford a $390 monthly after-tax cost. At a 22% marginal rate, a deductible $500 IRA contribution has an economic after-tax cost of about $390. At a hypothetical 7% return, $500 monthly grows to approximately $609,985 inside the traditional IRA. Assuming a simplified 20% tax rate at withdrawal, the IRA leaves approximately $487,988 after federal tax. Investing $390 monthly in brokerage grows to approximately $475,789, including $140,400 of contributions. Taxing the approximate $335,389 gain, once at 15%, leaves around $425,480 in this simplified brokerage example. That creates a simplified IRA advantage of about $62,508, only because the contribution was deductible in our example. Real results vary with tax brackets, dividends, annual tax drag, fees, state taxes, investment choices, and future law. Now change one fact. Assume the traditional IRA contribution is completely non-deductible, and both accounts receive $500 monthly. After simplified taxes, the non-deductible IRA leaves about $523,988, while brokerage leaves about $545,488. That reverses the result by roughly $21,500, and actual IRA withdrawals follow pro-rata rules across your traditional IRAs. Brokerage also allows capital losses to offset realized gains, which can reduce taxes when used correctly. But the wash sale rule can disallow a loss when substantially identical investments are repurchased within the restricted period. A traditional IRA has no employer match. If your workplace plan offers matching money, capturing that match commonly comes first. Traditional IRA is strongest when the money is for retirement, the contribution is deductible, and you expect a lower future tax rate. Brokerage is stronger when flexibility matters, the IRA deduction is unavailable, or you are investing beyond the annual IRA limit. Use this decision tree. First, does your workplace retirement plan offer an employer match you have not fully captured? After the match, ask whether this money is strictly for retirement and whether your traditional IRA contribution is deductible. If yes, compare your tax rate today with the rate you realistically expect when withdrawing in retirement. If you may need the money earlier, want no required minimum distributions, or need more contribution capacity, brokerage becomes more attractive. For many people, the answer is both. Tax-advantaged retirement savings plus brokerage money for flexibility and overflow. One common mistake is opening an IRA, but leaving the contribution in cash instead of choosing suitable investments. Another is making non-deductible contributions without filing Form 8606, risking incorrect taxation and lost basis records. Final verdict. A deductible traditional IRA usually wins for retirement tax deferral. Brokerage wins for flexibility in non-deductible situations. Which fits you today? Traditional IRA, brokerage, or both? Comment below and verify current tax rules before acting.